Hello everyone, welcome back. Hi, my name is Professor Bhavin Gandhi and I am a Chartered Accountant and Company Secretary by qualifications. And today I am here to discuss your RTP November 22 for Inter CA FM paper. So guys, in this entire discussion, in this entire video, we will be revising all the questions which is there in your RTP November 22. Some of the questions I have solved it, some of the questions we'll be just referring to the solution, but just one small request, keep your calcs handy, keep your notebook handy, because I want you to solve, revise these questions along with me, because I'm very sure that towards the end of the video, after we complete this, all the questions of RTP will be conceptually clear in your mind. So let's get started without wasting any further time. We'll be starting with the first question now regarding your ratio analysis. So now students, let us start with the first question of ratio analysis. So what is given to you in this question? The following information of ASD Limited relate for the year ended 31st March 22. Here we have the net profit available, which is nothing but 8% of sales. Raw material consumed, they have told you it is 20% of cost of goods sold. Direct wages is your 10% of your COGS. Stock of raw material is 3 months usage. So we have raw material holding period available. Then we have stock of finished goods, that is nothing but 6% of your COGS. Gross profit is 15% of sales. Debt collection period is your 2 months and all the sales are on credit basis. Current ratio we have 2:1 and fixed assets to current assets is available as 13:11. Long-term loans to current liabilities is 2:1 and capital to reserves and surplus is 1:4. So you are required to prepare the profit and loss statement of ASD Limited for the year ended 31st March 22 in the following format. So guys, we have the financial statement format readily available, in which we have on the debit side to direct material consumed, then we have to direct wages to factory overheads, then on the credit side we have sales, then the gross profit carried down is given to you, and then in your P&L account we also have selling and distribution expenses, and then we have the net profits. And then we are also required to prepare the balance sheet on 31st of March 22, and for that also format is readily available, in which there is share capital, reserves, long-term loans, current liabilities, fixed assets, and then in the current asset we have stock of raw material, finished goods, debtors and cash. Guys, this particular question of ratio analysis, we have to prepare the financial statements from the ratios which are readily available to us. So guys, there are basically 3 types of questions in ratio analysis. Either they will give you the financial statements and we have to calculate the ratios, or else they will give you the ratios and we have to prepare the financial statements, or else we have to calculate the ratios and then do the interpretation and analysis. So this particular question is about the ratios are given to us and we have to prepare the financial statements. And guys, we have the format readily available, and if you check the entire question, there is only one figure in rupees which is available, and that is nothing but your fixed assets, which is 1 crore 30 lakhs. So obviously we have to start with the ratios in which the fixed assets is involved, and then slowly and steadily we will be completing our financial statements. So whenever such kind of a question comes even in your examination, your first step is, let us prepare the format of your financial statement, and in this question we have a format which is readily available. So quickly we will prepare the format and then we will start with the ratios in which this fixed asset is taken into consideration, and then we'll be substituting these figures in your financial statements and completing it. Okay, so guys, let's get started with the format. We will quickly prepare the format for your question number 1, in which I will just write down profit and loss account for the year ended 31st of March 22. Okay. And in this particular question, as I told you, we have the things which are readily available. So let us substitute that by the way of your format. We have to direct material consumed, to direct materials consumed. Then we have the next thing, which is your direct wages. So you all can also solve this with me. After which then you have to works overheads, which is also known as your factory overheads, and then we have to gross profit carried down, and then I will be having by gross profit brought down. So this question will take little bit of time for you to understand, but the main thing is the process of solving the question is very important. So you should always know from where to start the particular question, especially in the questions where the ratios are available and we have to prepare the financial statements. So then we have selling and distribution overheads, and then we have to net profits. Also at the same time in this particular question we have to prepare the balance sheet as well. Balance sheet as on your 31st of March 22. In this balance sheet we have share capital, then we also have reserves and surplus, after which we have long term loans, and then we have current liabilities, and on the asset side we have fixed assets, and then we have the current assets in which there are some 4 elements. So what are there in your current assets? So we have stock of raw material, then we have stock of finished goods, then we have debtors, and eventually cash. So guys, we can write down the current asset individual items here, and in totality we can write down the figure here, and then your fixed assets plus current assets will actually give you your total assets. Also at the same time you must be aware that your share capital plus reserves and surplus is also called as your net worth, or these are also known as your equity shareholders funds. Okay. So guys, we have the trading P&L account and we have the balance sheet which is available in the format which they have given to you in the question. So how should we approach the question? So we have only one figure in rupees which is available, that is 1 crore 30 lakhs. So we can substitute your fixed assets as 1 crore 30 lakhs, and then guys we just need to start the ratios in which we have fixed assets available. So guys, in the question they have given to us fixed assets to current assets as 13:11, right? So definitely I can start with this ratio. Come on, yes or no? Yes. So let's start with that particular ratio, and guys always remember that while solving such kind of questions you prepare adequate working notes. So working notes definitely forms part of your solution. So in your working note, first we will start with fixed assets to your current assets. So that will be nothing but 13:11, and we have your fixed assets available as 1 crore 30 lakhs. So that will actually help you to calculate now your current assets, and that's going to be your 1 crore 30 lakhs into 11 divided by 13. So that's nothing but 1 crore 10 lakhs. So guys, we have the total of current assets available as 1 crore 10 lakhs, which I can substitute here as your total of current assets 1 crore 10 lakhs in your balance sheet asset side, and always give the reference to your working notes. So your working note number 1 will be your total of current asset which is 1 crore 10 lakh rupees. So this ratio we have taken into consideration, and then we have fixed assets to sales also, so we can start with that as well. So your second working note which is going to be your fixed assets to sales, and the ratio here is 1:3. So this is nothing but 1 crore 30 lakhs upon sales. Therefore, your sales will be 1 crore 30 lakhs into 3. So that comes as your 3 crore 90 lakhs. Now guys, after your sales is being calculated, we can substitute the same in your P&L account by sales, and that is nothing but 3 crore 90 lakhs, which actually comes from your working note number 3, or is it working note number 2? Okay. So this will be your sales working note number 2. Now my dear students, after we have solved this particular part, we have one more ratio which we can use it, that is current ratio 2:1. So guys, we have the total of current assets available. So your current assets upon current liabilities is nothing but your 2:1. And guys, I have the total of current asset is 1 crore 10 lakhs. So which will actually help me to calculate your current liabilities. Therefore, your current liabilities is gonna be 55 lakhs, which we can substitute here on your liability side, 55 lakhs. And this will be your working note number 3. Now obviously guys, I have the total of the assets available. So it's nothing but 1 crore 30 lakhs plus 1 crore 10 lakhs, which will actually give you 2 crore 40 lakhs, and this will also be your 2 crore 40 lakh rupees. So we have the total of your balance sheet now available. So guys, your first, second and third ratio you have taken into consideration. Now you can also use this long-term loans to current liabilities. So as and when one single figure is available, your correct approach will help you to calculate your multiple answers. Now we have long-term loans to current liabilities, and I can definitely use that particular ratio. So your fourth working note, long-term loans to current liabilities, and the ratio available is 2:1. So that is why we have your current liabilities as 55 lakhs. So therefore, your long-term loans will be 1 crore 10 lakhs. So now we have 1 crore 10 lakh as your long-term loan. And guys, this will be your reference to working note number 4. So obviously now we have the net worth available, yes or no? Yes sir. So now from 2 crore 40 lakhs, if I subtract 55 lakhs and then if I subtract 1 crore 10 lakhs, eventually what will I get is 75 lakhs. So 75 lakh is my net worth, it's my equity shareholders funds, and now we need to divide and we need to bifurcate this 75 lakhs in your capital to reserves, which is in the ratio of 1:4. So I can very well state it here only that my share capital is 1/5 and my reserves is 4/5 because the ratio is 1:4. So then I'll be having my share capital as your 15 lakh rupees, and then my reserves and surplus will be 60 lakh rupees. So this will eventually help me to now find out the breakup of capital and reserves and surplus. So guys, I hope you have understood that my balance sheet liability side is now complete with all respects. So eventually all these ratios are now taken into consideration. Now if you proceed further, now we have the items which will help us to actually prepare your trading P&L account, in which we have the first item, that is net profit, that is 8% of sales. So guys, do you have the sales available, yes or no? Yes. So now we can start with your net profits, and that is nothing but 8% of 3 crore 90 lakhs. So that will be nothing but 3 crore 90 lakhs into 8%, 31 lakh 20,000. So we have this net profits also available. Now many students must be wondering, sir, this net profit should actually be now passed, or it should be transferred, or it should be posted to your reserves and surplus. But you always remember that this reserves and surplus is always your closing reserves and surplus, and this closing reserves and surplus always has opening reserves and surplus and plus the profits which is being transferred to it. So you don't have to further add any kind of net profits to this particular reserves. Okay, so this is your closing reserves and surplus. So coming back to this particular part, we are already done with your net profit ratio. Now we also have your raw material consumed, which they have told you it is nothing but 20% of your cost of goods sold. But before that, let us first calculate your gross profit, because guys, your thinking process should be what? That we have the sales available, we have the GP percentage available. So sales into GP percent will actually give you your gross profit, and sales minus gross profit will eventually give you your COGS. So we have the gross profit as your 15% of sales. So I can simply take whatever is going to be my sales, I need to just multiply that by 15%. So from 3 crore 90 lakhs, if I multiply it by 15%, I'll be eventually getting 58 lakh 50,000. And this will be my gross profit brought down, 58 lakh 50,000. So obviously I also know that my total of P&L account here will be 58 lakh 50, and from 58 lakh 50, if I subtract 31 lakh 20,000, this will actually help me to calculate your 27 lakh 30,000, which is nothing but your selling and distribution overheads, and that is your balancing figure. So guys, coming back now to my cost of goods sold, can I say sales minus GP will eventually give me my COGS, yes or no? Yes sir. So guys, now we will prepare a working note for the same. So we will write down working note number 5, calculation of COGS, and that is nothing but sales minus GP. This actually gives you your COGS. So your sales is 3 crore 90 and GP is, you just now got the amount, which is 58 lakh 50,000. So from 3 crore 90 lakhs, if I subtract 58 lakh 50,000, I'll be getting 3 crore 31 lakhs and 50,000 rupees. So that's my COGS. Now this COGS will eventually help me to calculate raw material consumed, direct wages and all those other things. So your raw material consumed is 20% of your COGS. So we know that your sixth note, that is raw material consumed, is 20% of 3 crore 31 lakh 50,000. So that will be nothing but 66 lakh 30,000. So that's your RMC. So I can write down your RMC as raw material consumed as 66 lakh 30,000. And also at the same time, give your reference to working note number 6. So now we'll be starting with your direct wages, and your direct wages is 10% of your cost of goods sold. So now you'll be having working note number 7, and that is your direct wages, which is nothing but 10% of COGS, that is 3 crore 31 lakh 50,000. So eventually this will be 33 lakh and 15,000 rupees. So now we have the direct wages available as your 33 lakh and 15,000. So that actually comes from your working note number 7. So obviously your works overhead is going to be your balancing figure. So that will now be from 3 crore 90 lakhs. Now let us subtract 66 lakh 30,000. We will subtract 33 lakh 15,000, and then we will subtract 58 lakh 50,000 to eventually get 2 crore 32 lakh and 5,000 rupees. So guys, with this now your works overhead is also completed, and you will realize that your trading P&L account is now complete with all aspects. Now on your balance sheet asset side, we just now have to find out the breakup of raw materials, finished goods, debtors and cash. So how would you do that? So for this we have certain ratios available like your stock of raw materials, which is nothing but your 3 months usage. So we have the stock of raw material holding period available. So guys, when we have the holding period available, we have the raw materials consumed also available. So this will help us to actually calculate your stock. So one of the best way to understand this is, that when we have your RMC or your direct material consumed as 66,30,000, can I say this is your 66,30,000 on per annum basis? Now, for how much period of time the money is getting blocked in your stock? So that is given to you as your 3 months. So basically we can always calculate your stock like this by preparing working note number 8, and this will be your stock of raw materials. So guys, we know that your per annum raw material consumed is 66,30,000. So guys, for 3 months your money blocked will be how much? So your stock of raw material is now going to be 66,30,000 into 3 divided by 12, which will give you 16,57,500. So that's your stock of your raw material. So this stock of raw materials I can very well substitute here, which is 16,57,500, and this comes from your working note number 8. So guys, this is your stock of raw materials. So we have the time period available, we have the raw material consumed available. So this will help us to calculate your stock of raw materials. Now this stock of raw materials, if I want, I cannot substitute that in my trading account, profit and loss account. Why? Because here it's given to you as direct materials consumed. So consumed itself means what? Opening plus purchase minus closing. So guys, don't make a mistake of substituting that here. Your P&L account is now actually completed and it is as per the format which is available. So your consumption includes everything, opening plus purchase minus closing. So the only effect which will come here will always be in your balance sheet asset side, in your current asset, that is your stock of raw materials. So guys, with this your stock of raw materials is over, and now stock of finished goods, which is 6% of your COGS. Guys, we already have the COGS available. So now we can calculate with your working note number 9 your stock of finished goods, and that is nothing but how much percentage have they mentioned? It is 6% of your COGS. So we have the COGS available as 3,31,50,000, and I need to multiply that by 6%. Alright? So 3,31,50,000, let us subtract 6% to it. So this will be 19,89,000. So that's your stock of finished goods, which I can substitute here, 19,89,000, and which actually comes from your working note number 9. So guys, slowly and steadily your breakup of current asset is also getting completed. Now the last thing which remains here is nothing but your what? It's your debt collection period, which is 2 months. So guys, we have credit sales available, and guys, all sales are on credit basis, and that is given to you on per annum basis, which is 3,90,00,000. So again, we can calculate your debtors by considering that 3,90,00,000 sales is on per annum basis and your debt collection period is just 2 months. So we can take 3,90,00,000 into 2 divided by 12, and that will give you your 65 lakhs. So guys, there is no need to even remember the formula for your debt collection period, which is closing debtors upon credit sales. We can just do this by the way of logic, and your debtors will be 65 lakhs, which I can substitute here, which comes from your working note number 10. So eventually guys, your cash bank will be your balancing figure, and which will be 1,10,00,000, from which we'll subtract 16,57,500. Then we will subtract 19,89,000. Then there is 65 lakhs. So eventually this will be 8,53,500. So guys, with this your entire balance sheet also gets completed. So I hope you have understood the process of solving the question. Okay. So we have prepared your profit and loss account like this as per the format which was available. Then we prepared the balance sheet, and then we prepared 10 working notes based on the figures which were readily available, we started our ratio analysis with that. Okay. So guys, with this now you complete the revision of your first question of ratio analysis, and all the ratios are taken into consideration. Okay students, so now let us start with the next question, and the second question is regarding your cost of capital. And this is for the first time that institute has introduced such kind of a question in your cost of capital chapter. So it's a request that if you can do this together with me, it will be really very helpful. What is given to you that Bounce Limited evaluate all its projects using a discounting rate of 15%, and its capital structure consists of your equity share capital, your retained earnings, your bank term loan and your debentures which are redeemable at par. Rate of interest on bank term loan is 1.5 times that of debenture, and the remaining tenure of debenture and bank loan is 3 years and 5 years respectively, and book value of equity share capital, retained earnings and bank loan is given to you as 10 lakh, 15 lakhs and 10 lakhs respectively. And after that, debentures which are having a book value of rupees 15 lakhs are currently traded at rupees 97 per debenture, and the ongoing PE multiple for the shares of the company stands at 5. You are required to calculate the rate of interest on the bank loan and the debentures if the tax rate applicable is 25%. So first understand what is asked in the question. They have asked you to calculate rate of interest on your bank loan and on your debentures. So basically here, do you have bank loan as a source of fund? Yes or no? Yes sir. But they have not given to you how much percentage is the rate of interest on which you have taken the term loan. Similarly, do you also have debentures? Yes or no? Yes sir, that is also one of the source of finance, but they have not told you how much percentage is the rate of interest. So basically in this question we have to find out the rate of interest of your bank loan also and of your debentures also. But guys, the best part is the first line of the question, in which it is specified that it evaluates all its projects using a discounting rate of 15%. Which actually means that the company has a cost of capital of 15%. So it has your weighted average cost of capital which is available as 15%. See, basically you all know in cost of capital, ultimately when you calculate your WACC or your KO, how do you apply that? You definitely apply that for the purpose of doing analyzing in a particular project. What should be your discounting factor? So your KO and your WACC actually becomes your discounting factor. So in this particular question, we have the discounting factor or your WACC available as 15%. We now just have to calculate what should be the rate of interest for bank loan and debentures. So then you must be wondering, sir, what is the rate of your cost of capital available for your equity share capital and your retained earnings? So for that, my dear students, we have the P ratio available. So P ratio can actually help you to calculate your cost of equity as well as your cost of reserves and surplus as well. Okay, so what should be your approach to the question? How to start this particular question? So first of all, you have identified what is the required part, that you are required to calculate your rate of interest for your bank loan and for your debentures. Okay, because that rate is not available, but we have the WACC rate that is 15% available. So what we will do is now, as a standard practice, we will prepare one table to calculate your WACC. So you can just give the heading, solution to question number 2, calculation of rate of interest for debenture and bank loan. So for that we will write down weighted average cost of capital, and as you all know, we prepare sources of funds, then we have amount, then we have weights. After that, if I put my after tax cost of capital, what I get is my WACC. Now we have the book values available, so I will write down the book value weights. So we have some 4 sources in which we have equity share capital, and guys, the amount available for the same is nothing but 10 lakh rupees. Then we also have reserves and surplus, and the amount available for the same is 15 lakhs. Then we also have bank loan, and the bank loan available is nothing but 10 lakhs. And then we also have debentures. So your debentures is nothing but 15 lakh rupees. So guys, if you do the total of this, 10 plus 15 plus 10 plus 15, we'll be getting this total as 50 lakh rupees. And guys, this will actually help you to calculate now your weights. So this will be 0.2, this will be 0.3, 0.2 and 0.3. So your proportions we now have readily available. So what about your cost of capital for your equity share and reserves and surplus? See guys, whenever PE multiple is available to us, in the question they have told you that the ongoing PE multiple for the share is 5. So we have the PE multiple available as your 5 times. So we can use the PE multiple to actually calculate your cost of equity. So how do you do that? So guys, now I'll prepare your working note number 1, and that is nothing but calculation of KE, cost of equity. So when PE ratio is available, your KE is equal to 1 upon PE multiple. Now how do you get this K is equal to 1 upon P? As you all know, as per your earning yield approach, your K is nothing but EPS upon MPS. So if I take your EPS in the denominator, this will now be MPS upon EPS. And guys, what is MPS upon EPS? That's nothing but your P ratio. So can I say KE can also be equal to 1 upon P ratio? Come on, yes or no? Yes, sir. So we have your PE multiple available, so we can calculate your KE according to that. Or else you can also calculate KE with the help of dividend yield growth approach, earning yield growth approach, capital asset pricing model, dividend yield approach based on the data available to you in the question. But whenever there is PE ratio available, you can calculate your KE by taking 1 upon PE. So you have your PE ratio available as your 5 times. So I will now take 1 divided by 5. And that will be nothing but 0.2 or 20%. So guys, your KE will now become 20%. So guys, I have my working note number 1 available, which actually helps me to calculate your KE, which is 20%. Guys, but what about KR, cost of reserves and surplus? So guys, your KE and KR both are going to be the same. So reserves and surplus also belongs to your equity shareholders. So basically your cost of equity and cost of reserves and surplus here is going to be the same, and that is nothing but 20%. So now we are just required to calculate what should be your bank loan and debentures. But guys, we have the total WACC available as 15%. So I have this total available as 15%. I just have to calculate this cost and this cost, and based on this my final calculations will be done. And they have asked you to calculate this rate of interest only for bank loan and for debentures. So guys, for this we have one more data which is available in the question, which will be very crucial for us to calculate these rates. And they have told you that rate of interest on bank term loan is 1.5 times that of debentures. So if I keep my debentures rate of interest as X, can I say my bank loan will become 1.5x. So now I have to start with this assumption. So I'll write down now my working note number 2. Let rate of interest for debenture be X. Therefore, bank loan rate of interest is equal to 1.5x. So guys, if I want to calculate now post tax rate, the applicable rate is given to you as 25%. Therefore, post tax bank loan rate of interest will be interest into 1 minus tax, and as you all are aware, interest is 1.5x and the rate of tax is 25%. So this will now help you to calculate 1.125x, right? So we have now post-tax bank loan rate of interest. Guys, they have also told you that the remaining tenure for debenture and bank loan is 3 years and 5 years. Guys, for bank loan, we don't need what is the remaining tenure, because for bank loan, to calculate the cost, we always take interest into 1 minus tax rate. But yes, for debentures, definitely it plays a very important role whether the debentures are irredeemable or redeemable. So this 5 years actually is of no use for you. We just have your rate of interest which is available. We'll simply multiply that by 1 minus your tax rate to get the post-tax interest rate, and that is nothing but 1.125x. So this is something which I can substitute here. Your bank loan is nothing but 1.125x. Okay. But now let's talk about debentures. So you can give the reference to your working note number 2 regarding your calculation of your bank loan rate of interest. So now let us start with your third part, and that is going to be your calculation of cost of debt for redeemable debentures. So this will now be calculation of cost of debt redeemable. So guys, for this you know what's the formula. It will be interest into 1 minus tax rate plus whatever is the redemption value. From this you subtract the net proceeds and we divide by n, and then we'll be taking the average of redemption value plus net proceeds upon 2 into 100. So guys, let the face value of the debenture be 100 rupees, and then we have considered the rate of interest to be x. So 100 into x, so your interest will be 100x and your tax rate is 25%, plus your redemption is happening at par because they specifically mentioned redeemable at par. But now the question arises, what should be your net proceeds? So guys, do we have the market price of the debenture available, yes or no? Yes sir. They have mentioned that this particular debentures are currently trading at rupees 97 per debenture. So do we have the market price of the debenture available? Yes, which is 97. So now my net proceeds will be 97 and the life of my debenture remaining is 3 years. So guys, when we have the market price available, we can replace your net proceeds with the market price, and then we will take on an average of 100 plus 97 divide by 2. So this will be 100 minus 97 divided by 3 upon the average. So this will now be 75x plus 1 upon 98.5. And because this rate of interest is always in 100, it's always on percentage terms, we can just simply write down this as 75x plus 1 upon 98.5. So we have this as your rate of interest available here, which will be nothing but 75x plus 1 divided by 98.5 divided by 98.5. So now this will be 0 into 20%, which is 4%, which I can also write this as 0.04. This will be your 6%, which can be 0.06. And then this will be 1.125, which I'll multiply it by 0.2. So that's going to be your 0.225x. And this is 75x plus 1 upon 98.5. So 75x, 75 I multiply this by 0.3, I will be getting 22.5x upon 98.5 plus 1 into 0.3, that is 0.3 upon 98.5. So basically what I have done is 75x plus 1 upon 98.5, I have just split that up to 75x upon 98.5 plus 1 upon 98.5. So that we have multiplied by 0.3. So that's how we have got this as 22.5x upon 98.5 plus 0.3 upon 98.5, and this will be nothing but 0.15. 15%, can I write this down as your 0.15? Yes or no? Yes. So now my dear students, we have all the data available on the basis of which we just now have to find out the value of your x. So let's do that. So now I'll prepare working note number 4 to find out the value of x. So that was your 0.04 plus 0.06 plus 0.225x, 0.225x plus 22.5x upon 98.5 plus 0.3 upon 98.5, and the total of this was 0.15. So guys, can I say this will now become 0.1 plus 0.225x plus 22.5x upon 98.5 plus 0.3 upon 98.5 is equal to 0.15. Now we have to take the common denominator of 98.5. So now this will become 0.1 into 98.5, because here the denominator is 1 and we want to make it as a common denominator as your 98.5. So this will now become 9.85 plus 0.225 into 98.5. So this will now become 22.1625x plus, this is the same 22.5x plus 0.3 is equal to 0.15. So taking this 98.5 here, this will now be 9.85 plus, we can definitely add your 22.1625x plus 22.5. So that will now be your 44.6625x plus 0.3, and this will now be 0.15 into 98.5. So eventually guys, this is 9.85 plus 0.3. So this will now become 10.15 plus 44.6625x. Now this will be equal to 98.5 into your 0.15. So that's nothing but 14.775. And guys, if I take my 10.5 here, this will now become 44.6625x is equal to, this will now give me 4.625. And eventually guys, if you want to find out x, this will be 4.625, which will divide by 44.625. So this will now give you, divide by 44.625, which will be eventually 0.10355, or I can write down this as 10.36%. So your 10.36% will be nothing but your value of x. That's nothing but your debenture rate of interest. So guys, your debenture rate of interest is 10.36%, because we have assumed that the rate of interest on debenture be 10.36, that is your x. So your debenture rate of interest is your 10.36%. So similarly, now for your long term loan from bank, what should be your rate of interest? So it is specifically given to you that it is 1.5 times that of debenture. So we are just now going to take 1.5 into 10.36, and that will be nothing but 15.54%. So guys, this is now your final answer which was asked in the particular question, that what should be your debenture rate of interest and what should be your rate of interest for your long term loan from bank. So I hope you have understood. The entire process is what? That first we have to assume your rate of interest on debenture as x. So this will become 1.5x. Okay, and then we calculated your all the other types of cost. We had the total available as 0.15, and eventually we got the value of x after substituting all this, which is 10.36%, and hence your bank loan rate of interest is your 15.54%. So too much of calculations pertaining to your calculation of x, but I hope you all have understood this particular question thoroughly. So this was now your question number 2, which was regarding your cost of capital. Okay students, so now let us start with the next question, and that is regarding your capital structure. Now this question is very often found in your study module as well. See what is given to you in your question number 3. ABC Limited provides you with the following information. We have your EBIT available as rupees 2,80,000. Then we have interest on debentures at the rate of 10%, that is 40,000. We have your EBT, which is 2,40,000. Income tax rate is given to us 50%, so that is 1,20,000. So obviously this will be nothing but your net profits after tax. Then we have the number of equity shares, which is 30,000. Then we have the EPS available as rupees 4, and your PE ratio, which is price upon EPS, is available to you as 10, after which your market price is given to you as rupees 40. And the company has undistributed reserves of rupees 7 lakhs, and it now needs rupees 4 lakhs further for the purpose of expansion. And this investment is expected to earn the same rate as the funds already invested. And you are informed that a debt equity ratio, that is debt divided by debt plus equity, if it is higher than 32%, then it will push the PE ratio down to 8, and it will raise the interest rate on additional borrowings to 12%. You are required to ascertain the probable price of the share if additional funds are raised by the way of debt, and if the amount is raised by issuing equity shares at the ruling market price of rupees 40 per share. So basically, my dear students, how do you recognize in examination it's a question on capital structure? When you read this particular statement, and what is that statement? That the company needs rupees 4 lakhs further for the purpose of expansion. When such kind of a statement is mentioned, what does it mean? That you will need a further sum of rupees 4 lakhs, come on, yes or no? Yes sir. So we have to now arrange for this 4 lakh rupees. So there are two options available. So what are the two options available? We can raise this 4 lakh rupees by taking additional funds by the way of debt, or else by issue of equity shares. So I always want you all to first start with your summary of financial plan. Okay, so this question will not be solving this in much more detail because it's a more common question, one of the questions which you'll also find in the study module, but you have to understand the approach and the process to solve this question. So what is going to be your starting point? Your starting point will be your summary of financial plans. Okay, and in your summary of financial plans, we have two plans available, plan 1 and plan 2. And guys, we have debt also as an option and equity also as an option. So guys, the total funds which is required is 4 lakh rupees. And plan 1 tells you that the entire fund should be raised by the way of debt. And plan 2 tells you that the entire fund should be raised by the way of equity. And here what is the most important thing is your number of equity shares, and we have some old shares also and we have some new shares also. And you guys can just check that the old shares which is available in the question is nothing but 30,000. So this 30,000 old shares will definitely be there under both the plans. But guys, new shares is only going to come in your plan 2, where your equity is 4 lakhs and you will have to divide this by the market price, which is 40. So 4 lakh divided by 40 will actually give you 10,000 shares. So ultimately you will be having the number of equity shares here as 30,000 and here as 40,000. So you must be wondering, sir, why this number of equity shares is required? Because eventually you are required to calculate your market price of equity share. So what is your market price of equity share? Whatever is your EPS, you multiply that by the P ratio. And to calculate your EPS, we need your total number of equity shares. So now we have the total number of equity shares, which is 30,000, and this is 40,000 shares. So first of all, in this particular question, there are plenty of things which are required to be calculated. First of all, do you have the existing income statement available? Yes or no? Yes. So now what should be your process? Sir, we have the existing income statement available. So with the help of this, first let us calculate what is your existing capital employed in the business. So you guys can just check that there is some debt which is at the rate of 10% and your interest amount is 40,000 rupees. So this will help you to calculate some debentures which are already there in the company. Come on, yes or no? Yes. So what's your debenture? So if I want to calculate my existing capital employed, so for my existing capital which I have employed, I have my debentures, and my debentures will be nothing but, can I say 40,000 divided by 10%, that is 4 lakh rupees. So I have a debt of 4 lakhs. Then I also have equity share capital available, which will be nothing but 30,000 into 10. So that will be 3 lakh rupees. And I also have some reserves and surplus available. And that reserves and surplus which is given to you in the question, that is nothing but 7 lakh rupees. So this is the funds which I already have, total amounting to 14 lakh rupees. Now, what is going to be my new capital employed? Can I say 14 lakh is the existing capital, and further we need 4 lakh rupees. So can I say my new capital employed is going to be now 14 lakhs plus your 4 lakh rupees. So that is going to be total 18 lakhs. Okay. But definitely this capital employed is going to fetch you some return. Come on, yes or no? Yes, sir. And they have told you that the investment is expected to on the same rate as the funds already employed. So what is the existing return on capital employed you are earning? So can I say my existing return on capital employed is whatever is my EBIT, if I divide that by my capital employed and I multiply that by 100, what I get is my existing return on capital employed. So guys, my existing EBIT which is given to you is in this question 2,80,000, and I have already got my capital employed as 14 lakhs. So ultimately you will be getting this return as 2,80,000 divided by 14 lakhs into 100. So that's nothing but 20%. So can I say my new return on capital employed is also going to be 20%, right? Because whatever is your old return on capital employed, it's going to be your new return on capital employed, which will now give me what is going to be my new EBIT. Because in capital structure, we always start with EBIT, then we subtract interest, we get EBT. So it's very important that we should first calculate what's your new EBIT, and your new EBIT will be whatever is your capital employed, you will multiply this by your return on capital employed. So you always have to understand this by way of process. First you prepare the summary, then you come to know what's your existing capital employed, then what is your existing EBIT, which will help you to calculate what's your existing return on capital employed. Then you will calculate new capital and multiply that by your return on capital employed. So this will now be your new capital was 18 lakhs, which we will multiply that by 20%. So eventually you will be getting your starting point, and that is nothing but 3,60,000. So when the income statement needs to be prepared, you know that your new EBIT is nothing but 3,60,000. So guys, one more important thing in this particular question is regarding your condition for P ratio and the additional rate of your borrowings. So in this question they have told you that if the debt equity, and that is nothing but debt upon debt plus equity, so that means your proportion of debt on the total capital employed, if it is higher than 32%, then there are two things which will happen. Number one, your P ratio is going to fall down to 8 times, and number two, your rate of interest on additional borrowings will become 12%. So let us check that particular condition. So your 7th point will be your calculation of debt equity. And guys, here we have two plans, plan 1 and plan 2. And this is nothing but debt upon debt plus equity, that is nothing but capital employed. So let us check our proportion of debt on your capital which is being employed. In plan 1, are you taking any additional borrowings? Let us check that out first. So in your plan 1, yes, you are taking some loan which is amounting to 4 lakhs. Guys, do you already have some existing loan? Yes or no? Yes sir. That is also nothing but 4 lakhs. So can I put it like this, that in plan 1, I am having old debt as well as new debt, that is 4 lakh plus 4 lakh, that is total 8 lakh rupees on my capital which has been employed, and that is nothing but 18 lakhs. So guys, 8 lakhs upon 18 lakhs, this will actually give you 44.44%, which means that in this particular plan, your proportion of debt is definitely exceeding 32%. So when your proportion of debt is exceeding your 32%, so there are two implications to it. Number one, your P ratio will become 8 times, and number two, your rate of interest is going to become 12%. So guys, that 4 lakh rupees which we are taking by the way of loan, which will have now rate of interest of 12%. But let us check for plan 2. Is this the same scenario? Because for plan 2, your old debt will be there 4 lakh, but there won't be any new debt. So this will be continued as 4 lakhs on your 18 lakhs of capital employed. So this will now eventually give you 22.22%. And this 22.22% is less than 32%. So obviously your P ratio will continue to be your old P ratio, and that's nothing but 10 times. But when it comes to your rate of interest, obviously there is no new loan, so there is not going to be any new rate of interest. So this is the summary, first of all, we have to understand, which is pertaining to your plan 1 and plan 2 and the proportion of debt in the capital structure. So your plan 1 definitely has higher amount of debt. So that is why your proportion of debt as compared to your capital employed is higher than 32%. So that is why your P ratio will fall down to 8 and your rate of interest is going to be 12%. But for your plan 2, because there is no new debt which we are taking, it will continue to be 22.22%, that is less than 32%, and hence your P ratio will be 10 times and your rate of interest for old as it is will be taken into consideration. So guys, now what should be your approach? So you will prepare your income statement, and if you can just check the solution for this particular part, Institute has also solved it in a very wonderful manner where you have your EBIT available. Can you just check the EBIT, which is nothing but 3,60,000 and 3,60,000, the EBIT which we got here as 3,60,000 rupees. So we have the EBIT available as 3,60,000, and then from this you have to subtract the amount of interest. So interest on old debentures will continue to be 40,000 and 40,000. And then interest on new debentures is at the rate of 12%. Why is it 12%? We just now checked in condition number 7 that when your debt equity will be greater than your 32%, then your rate of interest will be 12%. So that gives you 48,000. Of course, there is no interest here. And then from EBT, we will subtract tax. We'll be getting your net profit available for equity shareholders, which we divide by number of equity shares. For first case, it is 30,000. For second case, it is 40,000. And that is something which we had written in your first working note, in your first summary, 30,000 shares and 40,000 shares. So eventually, this will give you your EPS, from which you will multiply by the P ratio. And you guys can just check that in your first plan, your P ratio is 8 times. And why is it 8 times? Because your debt equity is crossing the limit of 32. Okay. And then you'll be getting the probable price of the share, which is 36.24 and 40 rupees. Okay. So with this, my dear students, we now complete your question number 3, which is regarding your capital structure. And I hope, my dear students, you have understood the entire analysis and interpretation along with the steps which we have taken into consideration. Okay. So your capital structure question is now completed. So now let us start with the next question. Now this is a question regarding leverages, and also one of the most common questions which you must have also practiced in your JK Shah classes material as well. See what is given to you in this particular question, that Debu Limited has currently an equity share capital of rupees 1 crore 30 lakhs consisting of 13 lakh equity shares, and the company is going through a major expansion plan and it requires funds to the tune of rupees 78 lakhs. So now you must be wondering, sir, we need now 78 lakh rupees. Yes, this is a combination of your capital structure as well as your leverages, because in this question they have asked you to calculate your financial leverage for each plan. Now see what is available, that there are 4 options given to you. Your plan 1 has issue of 7,80,000 equity share of rupees 10 each. Then your plan 2 has issue of 5,20,000 equity share of 10, and the balance is by the way of borrowing at 12% rate of interest. Your plan 3 has rupees 3,90,000 equity share of 10 each, and then there is 39,000 9% debenture of rupees 100 each. And your plan 4 also has a combination of equity and preference shares. And the EBIT is expected to be rupees 52 lakhs, and we are required to calculate the EPS in each of the above plans. So how do you calculate your EPS? So for that we have to prepare the income statement, which we start with your EBIT, which is available as 52 lakhs, from which you will be now subtracting your interest. Then we will be getting EBT. Then we will be subtracting your tax, we will be getting NPAT. And then we will be getting your net profits available for equity shareholders after you subtract your preference dividend. So don't forget, in this question, in plan 4, there is some preference dividend also. So if you now refer to your solution for this particular question, so you will come to know that we have the income statement available, which we start with your EBIT of 52 lakh rupees. So we have 4 plans available. So we have the EBIT available, and here this summary is very important. We have the existing equity shares which is available for all the 4 plans, and we just have to see where is the new issue which is happening. And preference shares is there in your 4th plan. Your 3rd plan has some debentures. Your 2nd plan has some long-term loans, and 1st plan does not have any interest because there is no debt in the capital structure. So guys, EBIT, you subtract interest, you get EBT, you subtract tax, you get NPAT, and then preference dividend, when you subtract, you will be getting the net profit for equity shareholders, which you divide by number of equity shares, you eventually get your EPS. So you all can see that the EPS for your plan number 3 seems to be maximum. But now let us also calculate your financial leverage. But to calculate your financial leverage, the only thing which you have to understand that in your 4th plan, your financial leverage will be calculated in a different way. Why? Because there is existence of preference dividend. So guys, eventually for your 4th plan, to calculate your financial leverage, you will use the following formula, which is EBIT upon EBT minus your preference dividend which you will divide by 1 minus tax rate. So this will actually help you to calculate your financial leverage. So guys, what is the amount of the EBIT? We already have the amount of EBIT available as 52 lakh rupees, correct? So this will be 52 lakhs. And now just check for your fourth plan, what is going to be your EBT? So your EBT available is nothing but 52 lakh rupees. So I will write down your EBT of 52 lakhs. And guys, your preference dividend here is nothing but 2,34,000. So this 2,34,000 we have to divide by 1 minus your tax rate, which is 40%. So we have to convert that preference dividend from your post-tax to your pre-tax. So that will be 2,34,000, which you are now going to divide it by 0.6. So that will be 3,90,000, which I am going to subtract from 52 lakhs. So ultimately this will be 52 lakhs, divide that by 48,10,000. So eventually 52 lakh divide by 48,10,000 will give you 1.08. And obviously, as you guys can just check, for plan 1, here there is no debt in the capital structure, hence its financial leverage is 1. And for plan 4, when there was preference shares available, we calculated in this particular manner. So your financial leverage was 1.08, and this is how we calculate the financial leverage for all the other plans as well. So it was a relatively very easy question to revise, but here we can come to know about all the types of financial plans, what are your EPS, and how do you calculate financial leverage by preparing the income statement. So guys, I hope you have understood this particular question. So this was regarding your leverages and your preparation of your income statement to calculate your EPS. So now let us continue further with the next question. Now this is your question number 5 regarding your investment decisions or capital budgeting. Now what is given to you? KKMM Hospital is considering purchasing an MRI machine, and presently the hospital is outsourcing the work received relating to MRI machine and is earning some commission income of rupees 6,60,000 per annum, which is net of tax. So currently you are earning a commission income of rupees 6,60,000 per annum post taxes, and the following details are given regarding the machine, where we have the cost of MRI machine, that is nothing but 90 lakh rupees. Then we have the operating cost per annum, which is excluding depreciation, that is 14 lakhs. Expected revenue per annum is available as 45 lakhs. And then we have the salvage value of the machine at the end of the 5th year, which is 10 lakhs. And then we have the expected life of the machine, that is 5 years. Assuming the tax rate at the rate of 40%, whether it would be profitable for the hospital to purchase the machine, and give your recommendation based on your net present value method and based on your profitability index. And then we have the PV factors also available for the period of 5 years. So guys, similar type of a questions also there in your study module as well as in your JK Shah classes textbook. We have to first understand that for the process of calculation of NPV, remember these 3 steps. Your step number 1 is calculation of NPV. The formula is PV of CI minus your PV of CO. Your step number 2 is your calculation of your present value of cash outflow. So basically there are 2 types of cash outflows. 1, your investment in fixed assets, and number 2, your investment in working capital. In this question, they have just told you that there is going to be some cost of machine, that is investment in fixed asset, that's nothing but 90 lakhs. So 90 lakhs you have to spend today. So 90 lakhs into 1, that will actually give you your present value of cash outflow, which is nothing but PV of CO. And guys, when it comes to present value of cash inflow, here we have to understand that there can be either cash inflows from projects, there can be your salvage value, and there can be recovery of working capital. So here there is no investment in working capital, so no recovery of working capital is going to happen. But definitely there is some cash inflow from projects, and that is nothing but if you are going to purchase your new machine. So now when you are going to purchase your new machine, definitely there will be some revenue which will be generated from the new machine. So we have to see what is the gross revenue, what is the cost incurred, how much taxes we are going to pay, and then we'll be getting the cash inflows. But here one of the most important part is that currently this particular hospital is outsourcing the diagnostic work to some other firm, to some other diagnostic center outside the hospital. And whenever guys this hospital is going to outsource some diagnostic work to someone else, definitely they will earn some commission from that other diagnostic center. But now when you are going to purchase your own MRI machine, definitely you are not going to outsource it, which actually means that whatever is your commission income, that will be lost. So there is going to be some loss in revenue. Come on, yes or no? Yes, which we can also call it as an opportunity cost. So guys, any inflow which gets avoided is to be treated as your cash outflow. It means that from the total gross income, total cash inflows which you are going to earn from this particular machine, from that we need to subtract whatever is going to be your opportunity cost on post-tax basis to eventually come to know what is the net cash inflow which you are earning from this particular project. So guys, just to make things more clear for you, we know to calculate your net present value, first of all we need your PV of CO, that's nothing but your 90 lakh rupees. So this 90 lakh rupees you are going to spend today into 1, so that's going to be your PV of CO. But when it comes to your PV of CI, we have your expected revenue, that is 45 lakhs. So that's your gross revenue, from which you will be subtracting your operating cost, that is 14 lakhs, and that's, they have told you, excluding the depreciation. So then this will give you your net profit before depreciation and tax, from which now you will be subtracting depreciation, and depreciation will be on SLM basis. We have cost as 90 lakhs, from which you will subtract the salvage value of 10 lakhs and you will divide by the life of 5 years. So basically this will be 80 divided by 5. Your depreciation is going to be 16 lakh rupees every year. So that depreciation you are going to subtract it, and then you will be getting NPBT, from which you will subtract the tax rate, and the tax is given to you as your 40%. So eventually you will be getting net profits after tax. You will again add back the depreciation to get your cash inflows. But guys, you have to remember that from that cash inflows which you are earning because of this particular machine, there is an opportunity cost which also needs to be subtracted, and that is nothing but this commission income, which is 6,60,000. So if this machine would not have been purchased, then you would have definitely earned this particular commission income. But now are you going to earn this commission income? Then the answer is no. So this commission income is your opportunity cost, and they have told you net of tax, so it's your post tax. So definitely from your final cash inflows, now you will be subtracting that 6,60,000 rupees to get finally your net cash, which you will multiply by your present value annuity factor. So cost of capital or your discounting factor will also be given to you in the question, that is nothing but 10%. So we'll be considering all this discounting factor summation, which is known as your present value annuity factor, because your cash inflows per annum every year is same. We'll multiply that by PVAF to finally get your PV of CI from the project. But don't forget that there is some salvage also which will be receiving at the end of the 5th year. The amount of the salvage is 10 lakh rupees. That will be multiplied by the discounting factor at the end of the 5th year to ultimately get the present value of salvage, and eventually we'll sum it up. That will be your PV of CI. So now I just want you all to check the solution for this. It's exactly at par with what we have discussed. You will come to know that there is sales revenue of 45 lakhs, from which we have subtracted the operating cost. Then we subtracted our depreciation of 16 lakh rupees. We got your net income, we subtracted tax, we got NPAT, we added the depreciation, we got this 25 lakh as your cash inflow. But don't forget that we are also going to lose on your commission income. That's your post-tax opportunity cost, 6,60,000. So eventually you'll be getting 18 lakh 40. Now this 18 lakh 40 you are going to get every year, and then we'll be getting this as your 3.169. So guys, just do the total of this present value annuity factor. You will come to know that the life of the machine is actually your 5 years. So if we take the total of all these discounting factors, which is 0.909 plus 0.826 plus 0.751 plus 0.683. So you'll be getting this as 3.169. But guys, life of the machine is actually 5 years. So here what you should do is, you should take into consideration the present value of your 5th year as well, which is 0.620. So that will be 3.789. So eventually this needs to be multiplied by 3.789 because life of the machine is 5 years. Hence we'll be taking into consideration year 1 to year 5. So that is going to be 3.789, and this 3.789 I will multiply it by 18,40,000 because that 18,40,000 is constant for 5 years. So this will now give me 69,71,760, and at the end of the 5th year you will be getting the salvage value, and the salvage value will be 10 lakh rupees. So that 10 lakh rupees will be taken into consideration. That 10 lakh rupees you will be multiplying it by 0.620. So 10 lakh into 0.62, that will eventually give you 6,20,000. And guys, if you do the total of this, you will be getting 69,71,760 plus 6,20,000 will be 75,91,760. So Institute here has taken your 5th year as cash inflow from the project, which was 18,40,000 plus your salvage value, or else you can also take year 1 to year 5, all the cash inflow of 18,40,000 on per annum basis, multiply that by 3.789. So you will be getting this as your PV of CI from project, and this will be your 10 lakh rupees if you multiply it by 0.620. So that will be 6,20,000, that is your present value of salvage, and you sum it up, you will be getting 75,91,760. So in both the approaches your answer is the same, and then when you subtract with 90 lakh rupees, eventually you will be getting 14,08,240. So that will be your NPV, which is negative, and if it is negative, definitely we will reject this particular project. And to calculate your profitability index, we will just take 75,91,760, divide that by 90 lakhs. So this will be 0.844. So your NPV is negative and the PI is also less than 1. Therefore, the machine should not be purchased. So you can do it by any one of the two methods. But always remember that whenever you are calculating your cash inflow from project, for every year, if the cash inflow is same, so we will take 18,40,000 and multiply that by your present value annuity factor for the period of 5 years, you will be getting 69,71,000, and just take salvage and multiply that by 0.620, you will be getting 6,20,000. So any which way which is comfortable for you, you can do it on that basis, but the conclusion remains the same, and NPV is negative and your profitability index is also less than 1. So definitely will not be selecting this particular project. So I hope you have understood. With this, now your investment decision question also gets completed. Similar type of question you have also done in your JK classes as well as your study module. So now this is regarding your capital budgeting. So okay students, now let us continue further with the next question, and this is an excellent question to practice for your risk analysis part. Now see what is given to you. Consider the below mentioned table for the risk premium and the coefficient of variation. So if your coefficient of variation is 0, then the risk premium is 0. If the coefficient of variation is between 0 to 0.25, then the risk premium is 2%. If the coefficient of variation is between 0.25 to 0.5, the risk premium is 3%. If the coefficient of variation is between 0.5 to 0.75, your risk premium is 4%. And if the coefficient of variation is between 0.75 to 1, the risk premium is 6%. See guys, you all are aware that coefficient of variation is one type of measurement of risk. If I increase the coefficient of variation, then definitely the risk increases, and we need to add a higher risk premium to it for the purpose of discounting. Because higher the risk, can I say higher will be the discounting factor? Come on, yes or no? Yes sir. So if you want to calculate the net present value And if suppose the risk in a particular project is higher, then definitely your discounting factor should also be higher. And coefficient of variation is one such measurement of risk, which is actually calculated by taking whatever is the standard deviation, we have to divide that by mean, and that will give you your coefficient of variation. So coefficient of variation will be your standard deviation upon mean. So if the coefficient of variation is higher, risk is higher, so premium will be higher, and that premium we need to add it to your risk-free rate to actually calculate a discounting factor, and then that particular discounting factor will be used to calculate your NPV. So guys, just check in this particular question what data is given to you. A company is evaluating two projects with an initial investment of rupees 1,50,000 for each project. So basically this is nothing but your present value of cash outflows, and they have told you that the cash inflows from them occurring at the end of the 5th year, which depends upon the possible scenario prevailing during the investment period. So guys, first of all, the cash inflows which is getting generated is something which they have told at the end of the 5th year. So all these are your cash inflows which is estimated at the end of the 5th year. So guys, here we don't have cash inflows on per annum basis, but we have the cash inflows occurring only once, and that is at the end of the 5th year. So you have to invest 1,50,000 today, and at the end of the 5th year, you might get 5 lakh also, you might get 3 lakh also, you might get 1,50,000 also, you might get 50 also, or you might get 10,000 also. And all these are known as your estimated cash flows with the level of probabilities which is given to you. So there is a 20% chance you might get 5 lakhs, there is a 30% chance you might get 3 lakhs, there is a 15% chance you might get 1,50,000, there is 20% chance you might get 50,000, and there is 15% chance you might get 10,000. So guys, we have the estimated cash flows, we have the probabilities. So basically we'll be getting the expected or the average cash flows. And guys, these average cash flows which we are receiving at the end of the 5th year, we have to discount it and we have to bring it to the present value terms. So what should be your discounting factor? So your discounting factor should be whatever is your risk-free rate plus whatever is going to be the risk premium. And the risk premium completely depends upon your coefficient of variation, which is actually given to you in the question. Can you just check there is coefficient of variation given in the question? Yes, sir. So now we have to take into consideration the coefficient of variation, and then based on the coefficient of variation, we will understand what is going to be the risk premium which will be added to the risk-free rate, and that will give you a discounting factor. So for example, if project X gives you your coefficient of variation of example 0.43, so 0.43 falls under which criteria? It falls in this criteria. So basically there will be 0.43, so we will be taking the risk premium of 3%. So automatically what is going to be your risk adjusted discounting factor? So 3% we will add it to your 6%, it will actually give you 9% discounting factor, and this 9% discounting factor will be taken into consideration to discount your cash flows from future value to present value terms. And guys, why I'm using the word future value? Because this is the cash inflows which you are going to receive at the end of the 5th year. So we will calculate the average cash inflows, and that average cash inflows will discount it and will bring it to the present value terms. So guys, how do you calculate first your average cash inflows and how do you calculate your standard deviation? Okay. So institute has also specified the same with the help of one particular table. Now you guys can just check that there is calculation of expected cash flows, then there is standard deviation, and then there is coefficient of variation. So we have the probabilities available. We'll multiply this by estimated cash flows. What do you get here is called as your average cash flows. And guys, these average cash flows will then be used as your X bar, and then we can take X minus X bar, we can square it and multiply that by probability to actually get your standard deviation. Okay. So for project X, I will help you to calculate and solve this particular part. So if you want, you can do this along with me. Okay. So now this is your question number 6. So in your question number 6, first let us calculate for project X. what should be your expected cash flows? Expected cash flows are also known as your average cash flows. Then what should be your standard deviation? And then what should be your coefficient of variation? So these are the three things which we are required to calculate. So basically, there are some situations here. So we can just write down how many situations do you have here. There are some 5 situations which they have told you, that at the end of the 5th year your situation can be superb, then it can be better, then it can be moderate, then it can be bad and worse. So these are the situations. Then what are your estimated cash flows? Just check that out. So this is 5 lakhs, 3 lakhs. Then there is 1,50,000. Then there is 50,000. And then there is 10,000. So you can calculate your expected cash flows or your X bar. How would you do that? So we have the probabilities available. Now see, what is the probability that superb will materialize? So that's 0.2. So I'll just write down the probabilities here. This is 0.3. This is 0.15. Then this is 0.2. And this is 0.15. Your total should be 1. So guys, what will be your expected cash flows? Of course, we'll multiply all these things. So 5 lakhs into 0.2. So that will give you 1 lakh. 3 lakh into 0.3. That will give you 90,000. 1,50,000 into your 0.15. That will give you 22,500. 50,000 into 0.2. That will give you 10,000, and 10,000 into 0.15, that will give you 1,500, and the total of this will be 2,24,000. So that's your average cash flows. So this is on an average which is expected to be at the end of the 5th year. So to calculate the NPV, we have to discount this 2,24,000 and bring it to present value terms. And to find out the discounting factor, we should know what is your coefficient of variation. And to know your coefficient of variation, it is very important that we should first find out standard deviation. So how do you find out standard deviation? So this will be x minus x bar, the whole square, and let us multiply that by probability and sum it up. Because your standard deviation will be nothing but root of whatever is your summation of probability into x minus x bar the whole square. So guys, we have x available. We have the x bar also, which is 2,24,000. So let us now calculate what should be the summation part. So guys, you can now use your memory function of your calc in the most efficient manner. What is given to you is your 5 lakh minus 2,24,000. So that will be 2,76,000. You have to square it up and then multiply that by your probability of 0.2. So you will be getting here 152352 and 5 times 0. Put that in your memory. Then we will take 3 lakhs and we'll minus 2,24,000. We'll get 76,000, which you will square it up and then you'll multiply that by the probability, which will be nothing but 0.3. So that will give you 17,328 and your 5 times 0. Then also at the same time, we have 1,50,000, which you will subtract it by your 2,24,000, 74,000. You square it up and multiply that by your probability of 0.15. You will be getting this as 8214, 5 times 0. And then you will be taking 50,000 minus 2,24,000, square it up and multiply that by 0.2, you will be getting 60,552 5 times 0, and then the last one is 10,000 minus 2,24,000, square it up and multiply that by 0.15. So this will be 68,694 5 times 0, and then whatever you have got the total, we have to take the root of it. So this will be root of 3714, and then the root of this will be nothing but 1,75,254. So this is your standard deviation. Now once you have the standard deviation available, now we can calculate the coefficient of variation, which will be your standard deviation upon mean. So that is 175,254, and your mean is nothing but your 2,24,000. So this will be nothing but 0.7824. So this is your coefficient of variation. Now what is the use and what is the application of this coefficient of variation? See, you can just check, you have got this as 0.7824, right? Now we need to check in the question that if this is 0.7824, it will fall in the last category where your risk premium added is 6%. So basically your yield is 6%, your risk-free rate is 6%. So your risk-free rate plus risk premium will actually give you your discounting factor. So guys, your risk-free rate is now 6%, and your risk premium, you have also got it as 6%. So eventually your discounting factor is 12%. So now what you should do? So this 12% will actually now be used as your discounting factor to calculate your NPV. So guys, to calculate your NPV, you know that NPV is nothing but PV of CI minus your PV of CO. So basically you know what's your PV of CO. Your PV of CO is 1,50,000. And what's your PV of CI? So whatever is your cash inflows, we have to discount it and we have to bring it to your present value terms. So guys, we have your cash inflows 2,24,000. So I'll be taking 2,24,000 and multiplying that by the discounting factor at 12% at the end of your 5th year. So how much is that coming? 1 divided by 1.12, 1, 2, 3, 4, 5. So your PV factor comes as your 0.5674, which will multiply that by the average cash inflows of 2,24,000. So you'll be getting 1,27,104, which actually gives you your negative NPV of 22,896. So 22,000, rounding of errors are okay. So this will be 22,896 or 22,900 rupees approximately, and this is your negative NPV. And if it is your negative NPV, will you invest in this particular project X? Then the answer is absolutely no. So guys, this is the process which you have to understand, and I have done this for your project X. The same process you have to apply it for project Y, and for project Y you will calculate it, and then you will be getting the NPV of 8640, which is your positive NPV, and hence will we go for your project Y? Come on, yes or no? Then the answer is absolutely yes. So this is how you are going to solve your question number 6, which is regarding your risk analysis part. I hope you guys have understood this. Okay students, so now let us start with your question number 7, that is regarding your dividend decisions. Now in this particular question, see what is given to you. Ordinary shares of a listed company are currently traded at rupees 10 per share with 2 lakh shares outstanding. Now ordinary shares means your equity shares which are available at rupees 10 per share, and there are number of shares existing 2 lakhs, and the company anticipates that its earning for next year will be rupees 5 lakhs. and existing cost of capital for equity shares is 15%, so that's nothing but your KE, and the company has certain investment proposals under discussion which will cause an additional 26,089 shares to be issued if no dividend is paid, or additional 47,619 ordinary shares to be issued if the dividend is paid. Applying the hypothesis on dividend decisions, you are required to calculate the amount of investment and the dividend that is under consideration by the company. So in this particular question, we have to use hypothesis. Now just a quick revision which you should all know regarding your hypothesis is that when you want to find out the value of company, how do you find out the value of company? It is nothing but n plus change of n into P1 minus I plus E the whole upon 1 plus K. Okay. So basically this is just a revision, so that's why I'm just writing down the formula, but we have discussed in much more detail about how this formula is also derived, which is also there in your study module. So we have n plus change of n. What does n indicate here? N indicate what is going to be your existing number of equity shares. Change of n is nothing but the fresh issue which you have to make. P1 is nothing but price at the end of year 1. I is nothing but the investment which will be made at the end of the year. E is your earnings at the end, and K is nothing but your cost of capital or the discounting factor. So this is how you will be getting the value of the company, which is nothing but n into P0. So in this particular question now, what is available is the data which is available to you is P0. Okay, so first we should write down the data which is available. P0 is available, which is nothing but rupees 10 per share. Okay, after this you have the existing number of equity shares, which is nothing but, they have told you that there are 2 lakh shares outstanding. So we have your N also as your 2 lakh shares, and then you also have that the earnings for next year will be 5 lakhs. So we have your earnings available as 5 lakh rupees, which is at the end of the year, and then we have your K, which is 15%. So K is your 15%, and then the company has certain investment proposals, and this will cause an additional 26,089 shares if no dividend is paid. So guys, if there is no dividend which is supposed to be paid, then your fresh issue or your change of N will be nothing but 26,089 shares. Okay, but obviously if dividend is issued, if dividend is paid, then definitely your fresh issue or your change of N, so if dividend is paid, we have 47,619. Now see, prima facie you have to understand this objective that if the company does not pay any dividend, then can I say retention can be used for the purpose of investment, yes or no? Yes. And when you are using your retention for the purpose of investment, automatically your fresh issue is going to be lower. And when if you are giving dividends, then obviously that your earnings, you have used your majority of the part for the purpose of distributing dividend. So definitely your retention will be lower for the purpose of investment. So your fresh issue is definitely going to be higher, yes or no? Yes. So this is common sense that if the company does not give any dividend, your fresh issue will be lower, that is 26,089, and if there is going to be dividends which will be declared, so your fresh issue will be relatively higher, and that is 47,619. So that's why your change in N will be different under both the scenarios, whether you distribute dividend and you don't distribute the dividend. Okay, but as you all know, what does says? That the value of the company ultimately is going to remain the same only whether you declare the dividend or whether you don't declare the dividend. So that's why is of the view that the dividend decision policy does not impact the value of the company, it's going to remain the same. Okay, but in this particular question, we are not here to prove that the value of the company will remain the same whether dividends are declared or not. In this particular question, you are required to find out what should be your investment. So your I is missing in this particular question, but we have change in N available. Okay, so I is missing in this question. How much investment is to be done, that is missing in the question. And second, you have to find out that what should be the dividend which should be paid by the particular company. So if the dividends will be declared, then what should be the amount of dividend, that is something which is asked in the second part of the question. So this question you have to understand from what perspective, what information they are asking you. In all the questions of till now, your investments was available, but in this particular question, do we have to find out that amount of investment, yes or no? Then the answer is absolutely yes. So you guys can just check that we are having in this particular question your all the other data available. So we can find out your I first. So how would you do that? Okay, now see, if your dividends are not declared, then how will you find out your I? So let us focus on that. We have P0 available, we have N, we have earnings, we have K. Okay, so this information, and we also have your change in N. This will actually help you to find out your I. Okay, so let us focus like this. If the dividends are not declared, now we are discussing that if your dividends are not declared, so basically what will be your P1? Can I say basically your price today is nothing but the combination of P1 plus D1 upon 1 plus K, because whatever is your future value cash flows, if you discount it and bring it to the present value terms, what do you get? The value as on today. So if you want to find out the price of an equity share as on today, you know that you can use this formula P0 is equal to P1 upon 1 plus K, and we will add D1 upon 1 plus K. But obviously if no dividends are declared, so this part is going to be 0. So basically your P0 will be nothing but P1 upon 1 plus K. Now do you have the P0 available? Yes, and that is nothing but 10 rupees. So we have this as 10, but we don't have the P1, but it's okay. We have the K, which is nothing but 15%. So basically we are now in the situation to find your P1, and this will be 1 plus 15%. That's nothing but 1.15, and the moment you multiply this by 10, you will get your P1 as 11.5. So just check, do you have the P1 as 11.5? Yes or no? Yes sir. But that is only possible when you don't declare the dividends. So when the dividends is not declared, your P1 is nothing but rupees 11.5. Okay. Now, how will you calculate your investments? So guys, can I put it like this? Your fresh issue is completely based on whatever is your investments minus retained earnings, and you divide this by your P1, price at the end of year 1. This will actually give you your fresh issue of number of equity shares. So how much ever investment is required, suppose you require investment of 1 lakh and you have retained earnings of 70,000. So obviously your fresh issue will be 30,000 rupees only, yes or no? Yes. And this fresh issue, when it will be done at the end of year 1, you will need the price at the end of year 1, and this will actually give you your change in N. So basically whatever is your fresh issue which is to be done, that is something we divide by P1 to actually get your change in N. So your change in N is nothing but investment minus, can I elaborate retained earnings by taking earnings minus your dividends. So earnings minus your dividends will give you retained earnings. Suppose I am earning, example, 1 lakh rupees. And from that 1 lakh, if I have distributed 30,000 by the way of dividends, then can I say my retention is nothing but 70,000. So from your earnings, if you subtract your dividends, what you actually get is your retained earnings. And now if I divide this by P1, I will definitely get my change of N. So guys, if I open up this bracket, this will be change of N will be nothing but I minus E plus ND1 upon P1. Can I say your change of N will be investment minus earning plus ND1? If that bracket is open, your signs will change. So now eventually when we are talking about that if dividends are not declared. If you don't declare a dividend, if dividends are not declared, then can I put it like this, that change of n will be I minus E upon P1, because if dividends are not declared, your ND1 will be 0. So it will be eventually I minus E upon P1. And do we have your change of n, come on, yes or no? Yes, it's there in this question also, that if you don't declare the dividend, then your additional shares is 26,089. So we have this as 26,089. You have your investment which is supposed to be made, that is your X, your earnings is 5 lakhs, and your P1 you have just now calculated, it is nothing but 11.5. So if no dividends are declared, we know that your P1 is 11.5. Will this data help you to calculate your X, yes or no? Yes. So you can take 26,089 and multiply that by your 11.5. So this will be coming as your 3 lakh and 23 rupees, and if I take 5 lakh here, so ultimately it will become 8 lakh and 23 rupees, or approximately 8 lakh and 24 rupees. So this is actually 8 lakh rupees only, beta. That is nothing but your investment which is required. So they have asked two things in the particular question. The first thing they have asked is calculate the amount of investment. So have we calculated the amount of investment, yes or no? Yes. But our approach was what? That we started with, when the company does not declare the dividend, so what should be your P1? We calculated that, and then we also calculated that what should be your investment by using the formula, your change of N is nothing but investment minus retained earnings upon P1. So this will actually help you to calculate that we need your investments which is supposed to be made at the end of year 1, that is 8 lakh and 24 rupees. So this is the first part of the question. Now the second part is that what should be your dividends which is to be paid by the company. So now what you can do is, in this particular question, we have the P0 available, we have N available, we have earnings available, now we have I also available, we have KE also available, and we have change of N also available. So we have to find out the D1. Now in the second part, we have to do this with the help of some equation. How will we do this? First of all, what is price of an equity share? The same formula which I had written earlier, P1 plus D1 upon 1 plus KE. Okay. So here I have P0 as 10. I don't know what is my P1, because when the dividends will be declared, my P1 will be different. So I don't know what's my P1. I don't know what's my D1, but I know what's my K, 1 plus K. So ultimately we have got P1 plus D1 is equal to 11.5. Okay. So what's your P1? If I want to find out P1, then it will be 11.5 minus your D1. So understand this by the way of equation, that P1 is 11.5 minus D1. Okay, we'll be substituting this subsequently. Now, what is your change of N? So as we have discussed, I minus E plus ND1 upon P1. See, something which we have discussed here. Change of N is nothing but I minus E plus ND1 upon P1, right? So we have written here, change of N is I minus E plus ND1 upon P1. Now guys, we have change of N as 47,619, which is given to you in the question, that if dividend is paid, additional shares will be 47,619, and you have your I available, you have your earning available, and ND1 will be 2 lakhs into D1 and divide that by P1. So guys, can I put it like this, 47,619 into P1 will be 2 lakh D1 plus 3 lakh and 24 rupees. So guys, we know that this P1 is nothing but 11.5 minus D1. So we have to substitute this P1 here. So ultimately we will be getting 47,619 into 11.5 minus D1, and when we will calculate your D1, you will get your D1 as 1 rupee. So D1 will be 1 rupee available, because now there is only one missing figure, and that's your D1. So we have calculated your D1 as 1 rupee, and then we can substitute the D1 in equation 1. So you will get your P1, which is 10.5. And guys, ultimately, so we have to calculate what should be your dividends at the end of the year. So can I say that dividends at the end of the year will be nothing but whatever are your number of shares, we just have to multiply 2 lakh shares and your dividend is rupee 1. So rupees 2 lakh is your dividend which is supposed to be paid, and here they have also calculated what should be the value of the company. So for that particular case, your 2 lakh rupees is definitely that dividend which will be paid, and also at the same time this is your dividend which will be paid for your existing shares. So if you want to calculate what will be the total dividends, always remember that here the dividend which will be coming, that will only be for ND1, number of equity shares multiplied that by your D1. So your number of equity shares is 2 lakh shares only, you multiply that by your D1, you will be getting this as your rupees 2 lakhs. So when they have asked in the second part that what should be your dividend under consideration, so we know that the dividend per share is rupee 1 and the total dividend will be 2 lakh rupees. Now institute has done something extra here to calculate the value of the company. So your value of the company which will calculate by taking all this data, that will be nothing but 20 lakh rupees. Okay. So ideally this value of the company is just the extra part. We are just required to calculate up to the extent of dividend, and that will be whatever is here 2 lakh shares into your 1 rupee of dividend, and that will be 2 lakh rupees. So with this, now your question number 7 also gets completed. Too many calculations which is to be done. The first part I have solved it here, which comes as 8 lakh rupees of your investment, and to solve your second part you have to understand that we have to start calculating with the help of D1. So we will calculate two equations. One, we will use P1 and then we will substitute that P1 to finally get your dividends at the end of the year. Okay, so just practice this particular question one more time, and now with this your dividend decision also gets completed. Okay students, now let us start with the next question, and this question is regarding your management of cash. Now this is a very massive question. First of all, let us read what is given to you in the question. That a company was incorporated with effect from 1st of April 2021 and its authorized capital was rupees 1 crore divided into 10 lakh equity share of rupees 10 each, and it intends to raise capital by issuing equity shares of rupees 50 lakhs fully paid on 1st of April, and besides this a loan of rupees 6,50,000 at 12% per annum will also be obtained from a financial institution on 1st April, and further borrowings will be made at the same rate of interest on the first day of the month in which the borrowing is required, and all borrowings will be repaid along with interest on the expiry of 1 year, and the company will make the payment for the following assets in April. So we have plant and machinery which is available as 10 lakhs, land and building 20 lakhs, furniture is 5 lakhs, motor vehicles that is 5 lakhs, and stock of raw material is given to you as 5 lakhs. The following further details are available, in which we have projected sales available for April, May, June, July, August and September, and they have told you that gross profit margin will be 25% on sales. The company will make credit sales only, and these will be collected in the second month following the sales, after which the creditors will be paid in the first month following the credit purchases, and there is going to be credit purchases only. The company will keep minimum stock of raw material, and that is nothing but 5 lakhs, and depreciation will be charged at the rate of 10% per annum on cost on all the fixed assets, and payment of miscellaneous expenses will be rupees 50,000 which will be paid in the month of April, and wages and salaries will be rupees 1 lakh each month, and it will be paid on the first day of the next month. Administrative expenses of rupees 50,000 will be paid in the month of incurrence, and there is no minimum cash balance which is required. So you are required to prepare the monthly cash budget from April to September, then the projected income statement for the period of 6 months, and the projected balance sheet also as on 30th of September 2021. So guys, this is a very massive question because it takes into consideration your cash budget, it takes into consideration your projected income statement and also your projected balance sheet. So we have to prepare 3 things in this particular question. But prima facie, how to approach such kind of a question, that we are always going to start with your cash budget. And in cash budget, we will see that what is going to be your opening balance. We are going to add the receipts, we'll be subtracting the payments, and then we'll be getting the closing balances. And then we'll be approaching towards income statement and your balance sheet. So we have the solution for this available. As you can see, Institute has also first started with your monthly cash budget for the month of April to September. So here we have opening cash balance, to which we have to add your cash inflows. Then we have to subtract your cash outflows to ultimately get your closing balances. Okay, so these are your closing balances. Now my dear students, how should you approach the question? So one by one, first let us see that which all are your specific receipts and payments. And as you all are aware that in cash budget, we take into consideration your capital receipts also and your revenue receipts also. We consider your capital payments also and your revenue expenditure also. So everything which is going to have an impact on your cash bank balance, everything will be taken into consideration. So starting with what? If you consider here, you have first of all some data which is given to you regarding your issue of equity shares and your loans which are supposed to be taken. So we are going to substitute that on your receipt side. So you guys can just check here, there is an authorized capital of rupees 1 crore, but we are not concerned with authorized capital. We are concerned with how much is the capital which is being issued by the particular company. So it is mentioned that the company intends to raise capital by issuing equity shares of rupees 50 lakhs. So guys, will there be any receipt of your equity shares? Come on, yes or no? Yes sir, we are issuing equity shares, so there is going to be receipt of cash bank, and that is going to happen on your 1st of April. So that is going to happen in the month of April. So when you are preparing the cash budget, and it's a newly formed company, so definitely there is not going to be any opening balance. But yes, we are now going to issue equity shares, so definitely there is going to be some receipts which should appear on your cash budget. So as you all can just check, we are having cash inflows, and in the cash inflows, you can check that there is some issue of equity shares amounting to rupees 50 lakhs. So guys, we are not concerned with what is going to be the authorized capital, we are concerned with how much cash you are going to receive. So 50 lakhs will be nothing but in the month of April, you are issuing equity shares, you are going to receive this 50 lakh rupees. Also at the same time, you can check that we are taking some loan of 6,50,000 also, and that is also taken on 1st of April. So basically there is going to be 6,50,000 of your receipt in the month of April. So guys, here we also have loans which is nothing but rupees 6,50,000. Okay, so we have equity shares and we have loans. So we have 50 lakhs and 6,50,000 which is taken into consideration. And then they have told you that as and when if there is any loan which will be required, that loan will also be taken, and it will be taken at the same rate of interest. Okay, but for the time being, are we taking some loan in the month of April? Yes or no? Yes sir. Okay, now let us calculate what should be your payments. So in your payments, they have told you that all these capital expenditure as well as some investment in stock of raw materials, that needs to be done in the month of April. So guys, when you are starting with a particular company, then definitely there is going to be some investment in fixed assets. So there is some plant and machinery which you have purchased amounting to 10 lakhs. So you can just check that in the month of April, there is investment in plant and machinery 10 lakh rupees. Also at the same time, there is investment in land and building which is 20 lakh rupees. Then there is some furniture which is rupees 5 lakhs. Then there is some motor vehicles which is nothing but rupees 5 lakhs. And also at the same time, there is some investment of your stock of raw material, that is 5 lakhs. So guys, this is nothing but one type of investment in working capital, because when you want to do a particular manufacturing activity, you have to keep some stock of raw material. So in the month of April, we have taken this 5 lakh rupees as your stock of raw material. So this is your immediate investment as on today. So in the month of April, these all are your outflows which you can directly see from what is available in the question. Okay, so now continuing further, we have the sales which is given to you. Now we have sales from April to September, and the best part is they have told you that the company is going to make credit sales only. So basically we don't have any cash sales in the question. Also at the same time, we are not concerned with credit sales, we are concerned with how much money are we going to collect from debtors. So you can check that this will be collected in the second month following the sales. So basically here you can check that there is receipt from debtors. So whatever is your April month credit sales, if they might have told you that it is collected in 1 month, then this April month collection can be done in the month of May. But because they have told you that it will be collected in second month, so this April month 15 lakhs will be collected in which month? It will be collected in the month of June. So you can just check that April month, whatever is your 15 lakhs, that is collected in the month of June. So it is given to you specifically that it's a 2-month credit cycle. So whatever is your credit sales for the month of April, that will be collected in the month of June. Similarly, this is 17,50,000 and this will be collected in the month of July. Similarly, this is also 17,50,000 which will be collected in the month of August. And also this is nothing but 20 lakh rupees which will be collected in your September month. So the cycle is for the period of 2 months. So that's how you calculate your receipt from debtors. Now there is no working note which is required for the same, because this can be directly interpreted for the period of 2 months. But now the question comes about how are we going to deal with your payment to creditors. So for payment to creditors, you can specifically check that they have told you creditors will be paid in the first month following the credit purchases. So guys, whatever you are going to purchase, the payment will be made on the first month following the credit purchases, and there is going to be your credit purchases only. So what does that mean? It means that whatever you are going to purchase in the month of April, the payment will be made in the first month following the credit purchases. So there is going to be credit purchase only. So whatever you are going to purchase in the month of April, that is your credit purchase, and the payment will be made in the next month. So April month, whatever is going to be your purchases, the payment will be made in the month of May. May month, whatever is your purchases, the payment will be made in the month of June. So basically the whole idea is what? That whenever we are going to make the purchases, the payment is going to be made in the next month. So how do you calculate your purchases? So for that, we are having something which is called as your GP margin, which is 25% of sales. So now you can just check for the month of April, we are having sales of 15 lakhs and now your GP margin is 25%. So immediately when you subtract from 15 lakhs, your 25%, we will be getting your cost of goods sold, and that is nothing but 11,25,000. But now my dear students, don't you forget that there is going to be some wages and salaries also which you need to adjust from the same. So they have given to you the working of the purchases. So how are you going to calculate your purchases? Your purchases will be calculated like this. We have your sales, which is nothing but 15 lakhs, and from this sales we will subtract your GP margin, which is 25%, or you can just immediately multiply it 75% to get your cost of goods sold. And from that you will subtract the amount of wages and salaries, because wages forms part of your COGS. You know what is COGS? COGS is nothing but your opening stock, right? COGS is opening stock plus purchases plus direct wages minus your closing stock. Now your COGS is coming as 11,25,000. You want the amount of your purchases, right? So don't you think that you have to first adjust for direct wages? Come on, yes or no? Yes, because your COGS includes your direct wages, which is nothing but 1 lakh rupees. So the moment you subtract 1 lakh, this will be nothing but 10,25,000. So 10,25,000 will be your purchases. Now you must be wondering, sir, what about opening and closing stock? So they have specifically mentioned that this stock is always going to be constant. So basically your opening and closing stock of 5 lakh rupees will be maintained throughout the year. So automatically that will be nullified. So ultimately what is the balancing figure? That will be nothing but your amount of your purchases. So we have now your purchases amounting to rupees 10,25,000. So this 10,25,000 of your purchases, when will you make the payment of it? So the payment will be made in your next month. So can I say that April month's purchases will be paid in the month of May, which you can also check in the solution that we have payment to creditors amounting to rupees 10,25,000, and that is something which will be paid in the month of your May. So in May we will be paying 10,25,000. So similarly, now you can just calculate what do you think is going to be your purchases for the month of May, for which the payment will be made in June. So you can just check your sales is 17,50,000. From this we subtract your GP margin. So you will be eventually getting 13,12,500, from which you will subtract your wages, and this will give you 12,12,500. So this is your purchases for May, and as you know that this is your credit purchases, the payment will be made in the next month. So that's why this 12,12,500 should come in this particular month, and that will be your June. So similar to that, you also have to calculate June month purchases which will be paid in the month of July. Then July month purchases which will be paid in the month of August. August month purchases which will be paid in the month of September. So that's how you will be calculating your payment to creditors. For that, there is a working also which is available, and here it is mentioned that COGS minus wages and salaries, that will give you your purchases, and that purchases you have to calculate for each and every month. Okay. So that's how, my dear students, we are done with your payment to creditors, and we are also done with your collection from debtors. So basically your second point is taken into consideration, your third point is taken into consideration, and also your fourth point, which is with regards to your creditors. Now if you continue further, they have told you that wages and salaries will be rupees 1 lakh each month, and it will be paid on the first day of the next month. So basically whatever is the wages for the month of April, when are we paying? We are going to pay that in the month of May. Whatever is May month's wages, we are going to pay that in the month of June. So wages every month is the same figure, that is nothing but 1 lakh, but that is paid on the time period of 1 month's lag. So April will be paid in May, May will be paid in June, and so on. So you can just check here what is going to happen with your wages and salaries, April month's payment in May, May month's payment in June, and so on. And that's how your wages and salaries has been taken into consideration. But guys, if you continue further, they have also told us that there is some administrative expenses of 50,000 which will be paid in the month of their incurrence. So this is the most easiest transaction, because the month in which you are going to incur your administrative expenses, that is the same month in which you have to make the payment. So that's why 50,000 will be your administrative expenses for each and every month, April, May, June, July, August. So that is to be paid in the same month only. And then they have also told you that there is some payment of miscellaneous expenses of rupees 50,000 which will be paid in April. So are we making some payment of miscellaneous expenses in the month of April? Yes. So that is nothing but this 50,000 rupees. Okay. So basically we have also understood that there is going to be some stock which we have taken into consideration. Yes or no? Yes. See, here it is mentioned that we have taken stock of raw material, we have taken motor vehicles, furniture, land and building, plant and machinery, all these are your fixed assets. Then we have miscellaneous expenses of rupees 50,000 also. Then there is wages and salaries also. And also at the same time we have considered administrative expenses, and this payment to creditors is also taken into consideration. Okay. Now my dear students, continuing further, they have mentioned that depreciation will be charged at the rate of 10% on cost on all the fixed assets. Now is this depreciation going to come in your cash budget? Then the answer is no. And our first step is, right now we are focused on your cash budget, because depreciation does not lead to any kind of cash outflows. But yes, definitely that will be taken into consideration when we are preparing P&L account, because in your P&L account depreciation is an expenditure which will be debited. So that is something which is going to come in your P&L account. So basically this is pertaining to your depreciation. Miscellaneous expenses we have already considered, stock also we have taken into consideration. So with this you can just check that all the types of your receipts and payments we have at least taken into consideration in your cash budget, including your capital receipt and including your capital payments. So everything is now taken into consideration in your cash budget. Now, to check that whether there is any need for borrowings or not, Institute here has prepared one more working for the same. Now, if you want, you can also prepare this in this particular format, where you can take into consideration whatever is your opening balance, from which you will add the receipts, then you will subtract the payments. You will come to know that there is going to be some closing balance, and if your closing balance is into negative, we can add the borrowings here also to understand that what is going to be your balance which will be transferred in the next month. So you can prepare it in this particular format as well, or else Institute has separately prepared the working for this borrowings, and this borrowings they have considered as the part of the receipt side, so that the closing balance remains intact, which can be transferred in the next month. So any one of the approach is okay. Either you can prepare a working separately for borrowings also, or else you can include this as the part of your original cash budget as well, where you can write down the closing balance, and then if the closing balance will have a negative balance, then we have to take the borrowings which is specified in the particular question, so that the borrowings will be taken to keep or to meet the negative balances, and then the balance will be transferred to the next month. So now it depends upon you how you want to present in your examination. If there is lack of time, then what you can do is you can prepare it in this particular format only. Opening plus receipts less payments will give you closing, and just one more column there you can write down for borrowings part, and then the balance will be transferred to the next month. Okay. So in this particular question, Institute has prepared the format for your borrowings, where there is cash inflow and then there is cash outflow. As you know that in the month of April, we will be having these as your receipts which you have already taken into consideration. Then these are your purchases of fixed asset, your investment in stock, and all the types of expenses which you can take it directly from your payment side. And then you will be getting your total of your payments, which is coming as 46 lakhs, and here we were having the total of receipts which was 56 lakh 50. So you all can take on your calculus 56 lakh 50, from which you will subtract 46 lakhs. So you will be getting 10 lakh 50,000 as your surplus. So this you can treat it as your cumulative balance of 10 lakh 50,000, or else you can also understand that this 10 lakh 50,000 will be your opening balance for the month of May, which you can check here that in the original cash budget they have considered that 10 lakh 50,000 is nothing but the balance for the month of May. And then you will take the total of May, and you will realize that in month of May there is a deficit which is coming, and the deficit is amounting to 11 lakh. Your cumulative deficit is coming as 11 lakh 75,000. So basically what will happen is that when you will be taking opening balance, add receipts less payments, you will get a negative balance of 1 lakh 25,000. Now how will you meet with this negative balance of 1 lakh 25,000? So this 1 lakh 25,000 which is a negative balance, you have to take by the way of borrowings, because you cannot proceed further with this negative balance. So there will be 1 lakh 25,000 negative balance, so you have to take the borrowings, and when you take the borrowings, automatically your closing balance will turn out to be 0. So hence in the month of May, if you just check, your closing balance will be termed as 0, and hence your opening balance for the month of June will also be your 0. So basically in the month of May, is there any borrowings which is required, yes or no? Then the answer is yes. So as I told you, you can take into consideration borrowings here also as 1 lakh 25,000, because you will get here closing balance negative 1 lakh 25,000. Take borrowings, which means that the balance carry forward for the next month, it is going to be 0, and you can do it accordingly. So your institute has prepared a working for the same, and they have identified that there is some borrowings, but you can also do it as the part of your format. And then similarly for all the other months, there is no such type of deficit, so there is going to be some closing balance only which will be transferred to your next month. So then in this particular way, your cash budget will be over, and you will be having opening balance for each and every month, and then finally your closing balance will be calculated. And the balance at the end of September month will be 11,75,000. Now this balance is very important because guys, in this particular question you are also required to prepare the balance sheet. So as on 30th of September 2021, you will be having some closing balance which will be forming part of your current assets. So that is very important. Hence, this balance will appear on your balance sheet side. So now let us focus on your income statement and your balance sheet. Now you can see the format here. You have to prepare this in your T format only, even your income statement and also your balance sheet. Okay. So now which all things are going to come here? So we have two purchases. So from where will you get the purchases? Whatever purchases you have calculated in the working note, you just add all the purchases, you will be getting 83,37,500. Wages, every month it is 1 lakh rupees. So into 6, that will give you 6 lakh rupees wages. Also at the same time, there will be some sales. So your sales will be 1 crore 12 lakh and 50,000, which will be the combination of all these particular projected sales which is given to you. And then there will be closing stock of raw materials, which is 5 lakh rupees, which they have told that we have to keep this particular stock of raw material intact. And then you will be having this particular GP. This GP will be brought down here. Of course, it's a new company, hence there is no opening stock available. Okay, so that is something which you have to understand. And this GP will be brought down here. And then there are some admin expenses. How did you get this admin expenses? 50,000 rupees is per month, which you have to multiply it by 6. So that will give you 3 lakh rupees. Depreciation will be 40 lakhs at the rate of 10%, but this is for 6 months. So that's why only 2 lakh will be taken into consideration. Miscellaneous expenses, we have 50,000 rupees. And now there is some interest also which will be taken into consideration. Now they have specifically told in this particular question that interest will be paid towards the end. So we have to make the payment of interest towards the end of the particular year. So that is why we are just preparing it here for the period of 6 months. Hence we have to accrue that particular interest. We are not going to make any payment of the same. So how will you calculate this amount of interest? So there are two types of loans which you are taking in this particular question. The first loan which you are taking is on 1st of April, which is nothing but amounting to rupees 6,50,000, and the second loan you are taking is in the month of May. So basically here the rate of interest is going to be the same, but the interest calculation will be for different time period. So they have specified that by the way of your working note. Here 6,50,000 at the rate of 12% will be for 6 months. So that will come to 39,000 rupees. And whatever is your loan taken, 1,25,000, that is taken in the month of May. So that is going to be for the period of 5 months. So 1,25,000 at the rate of 12% for 5 months will give you 6,250. So the total will come as 45,250. So that is going to be your interest on loan together, 45,250. And this 45,250 will be forming part of your P&L account debit side as 45,250. But one more time I want to remind you, have you paid this 45,250 or this is your outstanding amount? Then the answer is this is your outstanding amount. And this outstanding amount you can check here also, that whatever is your accrued interest outstanding, that is 45,250 will be forming part of your balance sheet liability side. So basically now I hope you have understood that by doing these calculations, now your net profits will be 22,17,250. And now we can prepare the projected balance sheet. And in this balance sheet, we have authorized capital of 1 crore, but we are concerned more with the issued amount, and the issued capital is rupees 50 lakhs. And in reserves and surplus, whatever is the profits which we have earned, that will be transferred here. So that will be 22,17,250. Long-term loans taken is 7,75,000, which is the combination of the loan which was taken at the beginning, and that was nothing but 6,50,000, and plus your fresh loan which is taken 1,25,000. So together you will be getting 7,75,000. And in your current liabilities and provisions, we are going to have number one, your accrued interest 45,250. As I told you that whatever the interest which was debited, that will be forming part of it. You have outstanding expenses of 1 lakh rupees, because 1 lakh rupees of your wages, that is going to be paid in the next month. So April month wages we are paying it in May, May month wages, we are paying it in June. So similarly, whatever is your September month wages, we'll be paying that in October. So that's why that will be 1 lakh rupees of your wages. And now sundry creditors. For sundry creditors, you have to understand that whatever is going to be the purchases for the month of your September, that is something which you will be paying it in the month of October. So when you are preparing your September month's balance sheet, obviously there is going to be some outstanding payment to the creditors which you have to make. So when you have prepared the working for your purchases, you will understand that in that particular working of your purchases, you have September month purchases 15,87,500, and that 15,87,500, when we'll be paying that, we'll be paying that in the month of your October. So that's why this will be forming part of your outstanding creditors. So you can just check that here they have mentioned outstanding creditors or sundry creditors, which is 15,87,500. Coming to your balance sheet asset side, you can see the presentation first, how many types of assets are there. So we are having land and building, we are having plant and machinery, then we are having furniture, and we are having motor vehicles. And everywhere we have to charge the depreciation for the period of 6 months, and that will give you your net amount. So that is why the net amount will be taken into consideration, and be one more step more cautious that whatever is the total of this particular depreciation, that depreciation should reflect here in your P&L account debit side, which is nothing but 2 lakh rupees, okay, and which you can check here. 1 lakh is the depreciation for fixed assets for pertaining to land and building, plus 50,000, 1 lakh 50, plus 25,000, which is 1 lakh 75,000, and plus motor vehicle 25,000. So together 2 lakh rupees should be taken into consideration, okay. And then current assets, we have stock of raw material, which is there right from the beginning, which you have also taken into consideration as your trading account credit side by considering stock. So that stock will continue as your balance sheet current asset. Obviously, what will be your debtors? Your debtors will be nothing but whatever sales you have done in the month of August and September, and that will be received in October and November, because you know that for the period of your sales, your debt collection period is 2 months. So whatever is April month sales, you are receiving in June. May month sales you have received in July. June month sales you have received that in August. July month sales you have received that in September. But what about the sales for August and September? Can I say this sales together combined, when are you going to receive that? You will receive that post September, that is in October and November. So in the month of September, don't you think that this becomes your outstanding amount? Yes or no? Yes. So this is the amount which is supposed to be received. So that is why this debtors will be combination of your August and September month sales, which you can just check it out here. Your sales is 20 lakh for August, and for September it is 22 lakh 50,000. So combining this will be getting 42 lakh 50,000, and that is something which you will receive in the subsequent months. And guys, the closing balance of cash, you will definitely get it from your cash budget. On this basis, your balance sheet will then subsequently tally, okay. So this is how the process is. But first you should always start by preparation of cash budget, and then when you do income statement and your balance sheet, it will become much more easier for you. And to practice this particular part, I also told you that you can prepare the cash budget in this format as well, and you can include your borrowings as the part of the format. That will help you to save your very important precious time in your examination. You can directly take borrowings here and do it accordingly, okay. So with this, my dear students, your cash budget question gets revised. I hope you have understood this, but just practice it one more time so that you'll come to know about how to prepare your P&L account, balance sheet, etc. and everything. Okay students, now let us start with the next question, and that is your management of your working capital. So guys, in this particular question, first we have to calculate what is going to be your operating cycle duration, and use that operating cycle duration concept to calculate your estimation of working capital. Now just a quick revision, as you all are aware that whenever we need to make investment in your working capital, first you need to check that what is going to be your total annual operating cost, and also at the same time we should know what is going to be the time period for which the money will be blocked. Now let's say for example my total annual operating cost is example 12 lakhs, and if suppose my operating cycle duration is, let's say for example, 6 months, So what does that mean? That whatever is your money which will be blocked in the working capital, that will be released after the period of 6 months. So in that case, how much money of working capital will be required? So basically my total annual cost is 12 lakh rupees, but my operating cycle duration is 6 months. So basically my money which is rotated in the business, that money will be rotated for 2 times in a year. So basically the operating cycle duration is going to be 6 months and the number of operating cycles will be 2 times. So when I take 12 lakhs and if I divide by 2 times, I will go to the bank and ask for working capital amount of 6 lakh rupees, because that 6 lakh rupees which will be blocked on 1st of April, that will be released on 30th September. On 1st of October, again that 6 lakh rupees will be blocked, which will be released on 31st March. So my money will be rotated for 2 times in a year. And that's how my 12 lakh rupees of your per annum cost will be taken into consideration. So this is a very important concept, that here first we have to calculate the operating cycle duration, calculate the number of operating cycles, see what is the annual requirement, and then accordingly estimate the amount of working capital. Let's check this question number 9. What is given to you? Trading and profit and loss account of Beat Limited for the year ended 31st March 22 is given below, where we have to opening stock of raw material, work in progress and finished goods, and they have told you that all the purchases are on credit basis. We have wages, we have production expenses, and then we have gross profit carried down. So this will be your gross profit brought down. Then admin, selling, and here there is net profits. Also at the same time there is sales, and then there is closing stock, in which there is raw material, work in progress and finished goods. Now they have told in the question that the opening and closing payables for raw materials, it means they are talking about your creditors, is nothing but 16 lakhs and your 19 lakh 20,000 respectively, whereas the opening and closing balance of receivables, it means your debtors, that is nothing but 12 lakh and 16 lakh respectively. Now you are required to ascertain the working capital requirement by operating cycle method. So when they give the wordings operating cycle method, the first thing is we are required to calculate operating cycle duration. So operating cycle duration will actually be calculated like this, by taking into consideration whatever is your stock of raw material holding period, right? The time period for which the money is getting blocked in your raw material, we should take that. Then whatever is your stock of work in progress conversion period, how much time period does it require to convert from your raw material to your finished goods. So that's called as your work in progress conversion period. Then whatever is going to be your stock of finished goods holding period, and then whatever is your debtors collection period. So this together will give me my gross duration, the time period for which the money is getting blocked. And then if there is any creditors payment period, so I need to subtract that creditors payment period to ultimately get my net duration, and this net duration will be nothing but your operating cycle duration. So basically we are required to calculate the time period of these many 5 things, and then accordingly we will come to know what is going to be the net duration. So what is going to be the operating cycle duration, which will actually help you to understand for how much period of time your money is getting blocked. So if you can just check in this particular question, which all things do we have? So first of all, to calculate the stock of raw material holding period. See, basically the prima facie formula for stock of raw material holding period is what? That we can take whatever is your average stock of raw material, and we will divide that by raw material consumed into 365, 52 or 12. Now here if no information is given to you, we will always calculate this in days, and this formula is arrived by this simple logic, that whatever is your raw material consumed for per annum basis, we need to check for what is the average stock of raw material, how much time period will be required. So you simply take average stock of raw material, divide that by RMC into 365, that will give you your stock of raw material holding period. Also this 365 can be taken here. So raw material consumed divide by 365, that will actually give you raw material consumption on per day basis, and you can also take average stock of raw material and divide that by raw material consumption on per day basis, that will also give you your stock of raw material holding period. So anything is absolutely fine, whatever you are comfortable with, you can calculate your stock of raw material holding period. Here your answer is going to be the same, but institute does it by taking daily average consumption of raw material. So what do? That this 365, instead of keeping it here, they take your RMC and divide that by 365, so that you get consumption on per day basis. So it will be nothing but average stock of raw material upon daily average consumption of raw material. So don't be confused in this. You can also do it like this: whatever is your average stock of raw material, divide by raw material consumed into 365, you will be getting the same answer. Okay. So let us calculate one by one what is your raw material holding period. So for average stock, we need opening stock, we need closing stock. So we have your opening stock of raw material 14 lakh 40, closing stock is 16 lakhs. So this will give you 14 lakh 40 plus 16 lakhs divided by 2. So that will give you your average stock, and we have to divide that by consumption on per day basis, or else take your RMC and multiply that by 365, you will be getting 64.21. Now in this question, raw material consumed is not readily available, we have purchases available. So we can take the purchases, add opening stock of raw material, less closing stock of raw material, that will give you your raw material consumed. So on this basis, we'll be getting what should be your raw material holding period. Similarly, for your work in progress conversion period, you need whatever is your average stock of WIP, with which you are going to divide by cost of production. So how to calculate cost of production? So whatever is your raw material consumed, add wages, add production expenses, add opening WIP and less closing WIP, that will give you your cost of production. Similar to what you are supposed to be doing in your cost sheet. What do? We take direct material consumed or raw material consumed, you add direct wages, you add factory overheads or production overheads, then you will add your opening WIP and subtract your closing WIP to something which will be called as your cost of production. So your cost of production will be raw material consumed, direct wages, factory overheads, add opening WIP, less closing WIP. So for your WIP holding period, this cost of production plays a very important role. So we will get the cost of production as 1,23,20,000, which will be divided by 365, or else you can simply take your 365 here only and do it accordingly. We have opening and closing stock both available of your WIP. So then your conversion of WIP period will be nothing but 18.96 days. So approximately 19 days, that will be your stock of WIP conversion period. And guys, for your finished goods, then what do you have to do? If you continue with your cost sheet again, whatever is your COP, you add your opening finished goods, you subtract your closing finished goods, what do you get is called as your COGS. So opening stock of finished goods less closing stock of finished goods, when you subtract, what you get is COGS. So that's what they have done here also. Whatever is the production cost added with opening stock of finished goods and subtracted with closing stock of finished goods, will be getting COGS. So what you have to remember here is that whenever we are calculating the time period for raw material, work in progress and finished goods, they all are calculated in different way. For your stock of raw material, we have to take RMC. For your stock of WIP, we have to take cost of production, and for your stock of finished goods, we have to take your COGS. So accordingly, we will be getting the 3 time periods. And we have opening and closing stock both available in your trading and P&L account, which is actually given to you in the question. Now coming forward, you have got your 3 types of time period pertaining to raw material, WIP and your finished goods. How will you calculate your debt collection period? So in that particular case, you will take average debtors upon your credit sales into 365, or else take your credit sales and divide by 365 to get your per day sales. Accordingly, you will be getting 32 days as your debt collection period. Also at the same time, your creditors payment period will be nothing but your 73 days. But just be very careful that here you have to take purchases and not your raw material consumed. Because for creditors payment period, we will take average creditors upon credit purchases. So credit purchases we have it, and then we have got this as 73 days. So coming forward now, if you take all the types of raw material holding period plus WIP conversion period plus finished goods holding period plus your debt collection period, from which you will subtract your creditors payment period. So what you eventually get is your operating cycle duration. And then from 365, if you divide by operating cycle duration, you will get the number of operating cycles, which is 3.311 times. And then we will take the total cost. As I gave you in my example, suppose my total operating cost is 12 lakh rupees and I have a operating cycle duration of 6 months. So it means that number of operating cycles is 2 times. So from that 12 lakh, if I divide by 2 times, my estimation of working capital will be 6 lakh rupees. So similar to that, here also we are going to have first what is your total operating cost. So from your COGS, then you have added your P&L items, that is admin and selling. So you got this as 1 crore 40 lakhs. Now this is the total operating expenses on per annum basis. But we don't have to go to the bank and ask for 1 crore 40 lakhs of working capital, because your money is just getting blocked for 110.24 days. It means that you have a cycle of 3.311 times. So this is the money which is required. You simply divide that by 3.311 times. So 42,28,329 or 42,28,330 rupees will be your estimation of working capital. And this is the working capital which will be required for smooth functioning of the business. This working capital will be rotated in the business for 3.311 times, and that's it. This is the working capital which will be required. Okay. So this is how, my dear students, you complete now your question number 9. So I hope you have understood how to estimate working capital on operating cycle period basis. Okay students, so your last question, which is your question number 10, this is now your theory question, and one of the most common questions you will also find in your study module as well. And one of these questions were also asked in your past examination, that we have to compare what is your financial lease and your operating lease, and what are the features of your samurai bonds. So if you just look at your solution between financial lease and operating lease, you have also understood this in accounts. Your financial lease and operating lease, your first case financial lease, the risk and reward is passed to the lessee, and here the lessee is only provided the use of the asset and the risk is belonging to your lessor. So this is the first point which you have to understand. The lessee which will be bearing the risk for whatever is the obsolescence in the particular asset, and here the lessor has to bear the risk. So basically ownership belongs to your lessor in your operating risk, in your operating lessee. So in your operating lease part, the owner has to bear the risk. So that is why, the risk is not yet passed. So that is why everything belongs to the owner only in case of your operating lease. The risk is also there with the owner. The lessor is interested in the rentals and not in the asset, okay. But here definitely we have to take into consideration your rental part, and the lessor does not have any difficulty in leasing and the same asset to other willing lessee, and the lessee is kept cancelable by the lessor. So if you want that, you can immediately transfer that particular asset to someone else as well. And then the lessor enters into a financial transaction, and here the lessor has to bear the cost of repairs, maintenance, and everything will be borne by the lessor itself. So this is self-explanatory, just go through it once. It all depends upon who is the owner of the asset. So prima facie, just remember that under your financial lease, the risk reward, are passed to the lessee in case of your financial lease, and lessor in case of operating lease has to bear everything. So just remember this by the way of your one objective, that under financial lease everything gets passed to the lessee, and under your operating lease everything continues to remain with the lessor. Okay. So here the lessee usually makes the full payout, okay, and that is the single lease repays the cost of the asset together with the interest, and here every year you are going to get some money, and from various lessees when you are going to receive the payment, ultimately the cost of the asset will be recovered. Now in the second part, what are the salient features of samurai bonds? So just go through this particular part, that it is in yen, issued in Tokyo, and issuer is a non-Japanese company, and the purpose is to get an access of the capital which is available in the Japanese market. So when an Indian company is going to need some funds, then it can go to Tokyo, issue samurai bonds and get some money. Okay, so that is the whole objective of the samurai bonds. So guys, with this now your RTP also gets completed. This theory section, just read it once. Okay, these are most common questions which are asked in the examinations, and I hope you have enjoyed and understood whatever we have discussed. So wish you all the very best for your November 22 examinations. That's it from my end. Bye bye, take care, see you, bye.